most active firms in the community banking space. We represent banks across the country on a variety of buy-side and sell-side M&A engagements, capital raising, both stock and debt, private and public, as well as a variety of general corporate securities and regulatory matters for financial institutions. So I thought with that intro, we would just sort of dive right into the topic. And I think to get a sense in terms of what our panelists think regarding the outlook for bank M&A will be this year, be helpful to sort of talk about the environment for bank M&A over the last couple years. And thought Nathan could provide us a little bit of deal data for 2021 and 2022 leading up into this year.
Sure. Thanks, Jeff. Yeah, I mean, going back really a decade prior to COVID, M&A deals in the banking industry numbered around 250 a year, plus or minus maybe a little closer to 300 in a busier year. But that was fairly steady at 250 transactions. In the year 2020, obviously with COVID was a pretty unusual year, and that declined to about 112 deals. That was the slowest year on record for bank M&A. In 2021, there was a recovery. There was about 206 deals announced. So, this was the result of some deals that had been postponed from 2020 that went into 21. And also just generally, I think economic conditions had improved and some sense of stronger economic trends. That strength and activity, continued into 2022 for the first quarter. So there was some momentum in Q1 with about 49 deals announced, which again is on that run rate of 200 or so transactions. But activity slowed starting in Q2 and really remained subdued for the rest of the year 2022. So for the full year, there were only 168 deals announced. And again, almost a third of those were in the first quarter. And we'll talk more about some of the causes of that. But that has continued into the year 2023 as well, right? So this year we're off to a very slow start for bank M&A. There's only been 8 transactions that have been announced, and that's the slowest start going back to the year 2009. And so, that's again notable of the current M&A environment.
So I remember, Nathan, first quarter of 2022 last year, and people seemed to be pretty optimistic early in the quarter for bank M&A. I think the reasons we saw the pent-up demand in 2021 following the pandemic, seemed, and the environment seemed to be pretty optimistic in the beginning of the first quarter. What do you think happened? Obviously, there was some economic and things that happened with the Federal Reserve, during that first quarter. But can you sort of lay out your thoughts on, what caused 2022 to really turn downward and have a really, generally poor year for bank M&A, both from a quantity standpoint as well as from a deal value standpoint?
Yeah, no, it's a good question, Jeff. I mean, you're right. Economic uncertainty, I think, really, kind of began to unfold in second quarter. Heading into 2022, late 21 and early 22, we saw higher rates of inflation. Certainly knew the economy was doing well, but the Fed was going to react with raising interest rates to combat inflation. And I think from a banking perspective, and I'd say it probably started with investors in publicly traded bank stocks, concerns that rising interest rates could cause a recession or cause some economic slowdown, and that would have an impact on credit quality. And so there was concern of just kind of how the future would progress in a higher rate environment. And so far we really haven't seen credit issues, right? I mean, credit has been very good for the last several years, but when credit is very good, it's also a reality that there's only one way for it to go from here, right? So the timing of credit quality issues is very hard to pin down, but credit cycles, we will return to an environment where there are credit issues. So that's weighed on bank stocks, and that bank stocks affect the M&A activity, because buyers use their stock as a currency and to do deals and so forth. So, secondly, I'd say, more anecdotally, but there were a few transactions last year that were prominent deals that were poorly received in the marketplace, where the buyer stock price was down 5 or 10% on the day of announcement. And so for whatever reason, right? But that has created some environment of caution amongst buyers, not wanting to be viewed as overpaying or doing the wrong deal, or doing the deal at the wrong time. So I think that that has weighed on the environment as well. And then, as we talked about interest rates, I mean, the rapid rise of the Federal Reserve, moving 450 basis points in the fastest time ever, has caused some issues and just challenges, right? There's pros and cons to a rising rate environment for banks. But for M&A, two things really. One, there's higher levels of unrealized losses in the securities portfolio, which is the AOCI. And secondly, there's loan marks that are applied for purchase accounting on the loan portfolio, and those two factors together are dilutive to the buyer's pro forma book value, for book value of equity, and also pro forma capital ratios. So it makes for more challenges to put a deal together than where we were maybe a year or 18 months ago.
Laura, I think you completed, closed your most recent acquisition, right after the first quarter of 2022, and obviously I think you were going to be, somewhat, busy with integrating that acquisition. And so not sure, how quickly you would have otherwise looked to do a deal if the market, was more cooperative. But how did you view sort of the market, after the first quarter? Everybody was predicting interest rates to start moving up and the Fed to start acting for several years now. And there was always, some reason that sort of prevented the Fed from moving in that direction. In most recently being the pandemic and COVID. But what did you think about in terms of, Eagle and opportunity, looking at the environment and M&A environment, what really changed, particularly from an interest rate and economic standpoint?
Sure. Thanks, Jeff. Yeah, I mean, I think that we saw and felt the things that Nathan just defined. We did close in the second quarter one of our largest, or it was our largest acquisition to date, and things had changed by the time that we announced to the time that we closed. So I think that AOCI was becoming a factor. It did impact the way that we viewed deals. I think that it affected buyers' capital, our own capital, as well as sellers were not that willing to reduce their prices either. So it did have an impact. And then our depressed stock value that started the latter half of the year was impactful as well. So higher rates in general, I think, would impact the interest rate mark on the loans, and so that also is something we need to consider as we move forward. And the larger the deal, the more impactful those things can be. So the smaller deals maybe are not quite as they're still doable. So that's kind of how we're looking at it.
Did you see, Nathan, sort of a pretty big dichotomy between big banks and large banks, big deals, and small deals, sort of developing in 2022. I mean, if you look at, the number of deals, even though it was off, I think the deal value was really, more off than even the number of deals, which sort of suggests to me that really most of the deals we were seeing, and certainly most of the deals that, I was witnessing were mostly smaller bank deals, and there was a dearth of large bank M&A going on. Is that consistent with what you were seeing in the market?
I think so. I think just, there's it's hard to say the reasoning for that, Jeff, but some of the, there have been some of the larger deals that were poorly received. And, there's an argument for larger deals may have different, and higher execution risk. And so just, again, more cautious approach around larger deals versus, doing a smaller transaction. And again, just, limiting the risk that comes with M&A.
Amelia, obviously, these Crystal Ball webinars are sponsored by Holland Knight's financial service regulatory group, and so regulation plays a key role in bank M&A as a highly regulated industry. And so I think certainly the regulatory environment for M&A, bank M&A in particular, was pretty critical in terms of what happened 2022, not just the interest rates as well as the economic environment. So what was your thought on the regulatory environment and its effect on bank M&A in 2022?
Yeah, I think that we've kind of seen this transition from a deregulatory environment to a regulatory environment with the Biden administration. And this type of environment favors, more enhanced regulations, and it's really focused on promoting greater competition. We talked about all of these deals that have been happening over the last decade. And because so much bank M&A has occurred, there's been an increase in the number of large and larger banks. So this competitive focus is really focused on tamping down, large bank mergers. Like you've said, we've seen more small bank M&A, and we think that will likely continue, but we might see this increased focus on the regulatory environment trickle down to them as well. But also with, the increased regulatory environment and this transition from deregulatory to regulatory, seeing, longer processing times for bank M&A applications. We've seen a lot more additional requests for information and higher scrutiny. So things are not going through the regulatory process for banks as fast as they had previously. And this is likely due to the increase in regulations and the call to kind of change these merger guidelines, which have not really been updated since 1995.
Laura, did this sort of affect this regulatory environment? How did it affect in your most recent deal? How did it affect your thinking in terms of M&A going forward now that it potentially could take longer? And we are seeing it's sort of as Amelia suggested, dichotomy where smaller bank deals may get done under historical timeframes, where in some cases if there's issues that may not happen, and certainly larger bank deals are taking much longer to be approved these days. And so how did that weigh on you and your thinking, both with respect to your most recent deal as well as in terms of planning your M&A strategy going forward?
Yeah, this one took this past one just took a lot longer. There was a lot more scrutiny regulatory wise and delays. So when we were expecting to close in February, we closed at the end of April. So it just added to the cost, it added to the time, and that sort of thing. That said, we have pretty good relationships with our regulators, and and I think early outreach to the regulators when a deal is being contemplated. That's something that we have been doing and continue to do. We did, as a result of the issues that we had and delays that we had this past year in 2022, we did find some new contacts at the Fed that we now have a relationship with, and have somebody to call if something gets kind of bogged down like that.
Amelia, what factors generally are the regulators looking at when they're evaluating the bank merger applications, and what are the areas that can trip up banks in this process, or at least have in the last year or so?
Yeah, so typically in reviewing these applications, the regulators are really focused on the financial condition, obviously the acquirer, but the pro forma financial statements and things of that nature, managerial resources, and how the combined institution is going to look post-merger, convenience and needs of the community and consumer compliance, which kind of covers the Community Reinvestment Act and fair lending, and the effect on competition and financial stability that the combined institution will have and the merger will have. I would say in the past couple of months, we've started to see an increased focus on the due diligence process of the applicant, and an increased focus from regulators on the controls and procedures of the applicant that are in place, and how those will kind of play if the applicant is going to be acquiring a new business line in the merger. The regulators are also pretty heavily focused on safety and soundness, generally in the context of the merger, and then just in their typical safety and soundness examinations. For example, like in the context of a bank merger, the subject of the merger could not really have any of these prior enforcement actions or any MRAs, MRBAs, or if they're rated a 3 or less, they're not going to be able to engage in bank M&A. There are some circumstances where these institutions have kind of corrected these enforcement actions and then may be able to start up back in bank M&A again. But those are really the most critical factors. And I would say safety and soundness and effect on competition and convenience and needs of the community are really the heightened focus of the regulators, especially in light of the more higher regulatory environment that we're operating in.
And then how about in terms of convenience and needs? There's obviously been a lot of noise from community groups and protests, CRA protests, and maybe talk a little bit about how that affected the processing of applications, particularly in 2022, and certainly will affect applications, I think, going forward.
Yeah, so I think, like you said, we are seeing more community protests from these larger community groups, and in light of the Biden administration and the regulatory environment, they're becoming more empowered and have some more influence than we have seen in the past. So a lot of these community groups are banding together and protesting the merger under the Community Reinvestment Act. So some of these CRA protests have increased and ultimately are claiming that the parties to the merger and the pending acquisition have kind of failed to meet the needs of the community, and there's no clear public benefit to the transaction. Like I said, we've seen more of this recently, and the process kind of entails, so if a protest is received during the pendency of the application, the regulators will forward this protest, to the applicant with some written instructions to prepare a response, usually within a pretty short period of time, sometimes 8 to 10 days. The regulators can provide their own comments, and there's also the possibility of having a public hearing to kind of walk through the protests, which we've definitely seen recently in some of these larger bank mergers, and is something that ultimately, as an applicant, you would kind of want to avoid. In the context of CRA protests generally, I would say that there are a handful of outcomes. So the first would be the application survives the protest and is approved, but it would have been removed from the delegated processing time and the more expedited approvals. So this will add to those longer processing times that we were discussing earlier. I would say a second option is that the applicant negotiates with the community group that really lodged the protest, and convinces the community group to withdraw the protest, and then the application would go on to be approved. But again, not under that delegated and expedited processing time. And then a third option is that the application would be approved, but with these certain non-standard conditions imposed that the applicant and combined institution post-merger will need to address, which is obviously not ideal. And then the last and least ideal option would be that the regulator evaluated the application, the protest, and kind of indicates that it's going to be denied. So to avoid the being denied, then the applicant would withdraw their application.
Nathan, it seems to me that, prior to 2020, you pretty much knew, in a strategic bank transaction, a bank acquiring another bank, whether a deal was probably going to get approved if the target or the acquirer had any issues became apparent in the due diligence process. It sounds like that particularly, in 2022, there was some uncertainty in terms of timing and the speed of getting approvals, particularly for larger applications and larger deals. Did that affect, the advice you were giving on the sell side for your sell side clients as they were evaluating particular opportunities and looking at, what could be the timing on getting regulatory approval, particularly with some of this uncertainty in the market with volatility in stock prices, interest rates, the economy, and so forth?
Yeah, I mean, it's always an important part of, due diligence and just preparation. On the sell side, talking about the buyer's ability to close, very important issue. I think some of the things Laura talked about, are things we would advise a seller to make sure they're engaging with the buyer. That does the buyer have a good relationship with their primary regulator? Have they been proactive with communicating, plans for, their M&A strategy and so forth? So there's no surprises when an application is filed. And I think just, making sure, some buyers are going to be really well suited for that, and maybe some others aren't. And that, that's again, part of the diligence. And is there more risk with one party versus another, when you're choosing, which LOI to move forward with. And for a non-bank buyer, even higher, much higher execution risk to get a deal that can be approved. I'd say that's always been the case, but probably even more so over the last, 6 to 12 months or so.
Laura, in terms of the, CRA, my understanding is you've been pretty lucky in terms of not having any protests or issues in your market with any of the community groups. But as you look forward and sort of recognize the environment and sort of the potential, are you looking at, proactively, any, proactive engagement with, potential groups and sort of position yourself well for M&A going forward?
We go to great lengths to keep our CRA rating. We pay attention to community involvement, and we spend a lot of time and effort and money actually supporting our communities. So when we enter a new community, we do the same thing. We know that that's an important thing to be on top of. I think that we have not seen any actions or protests at this point, but we just may not be big enough to draw their attention too.
Sure. Amelia, we obviously are working on deals across the country of varying sizes. And, a lot of our, acquiring, our buy side clients have been pretty proactive in preparing themselves for this potential. Maybe give some thoughts on, what we're seeing from, particularly some of our larger buy side clients and trying to avoid, being bogged down in one of these CRA protests.
Yeah, so I think some of our larger clients have kind of taken the more proactive approach, and even way far in advance or even before the thought of a potential deal was on the table, they have kind of what Laura was saying, engaged with their community groups and have set up community benefit plans and things that really focus on the community in underserved areas and philanthropy, workforce and supplier diversity, and things of that nature. In the context of larger transactions, engaging with the community can really reduce, like we were saying, the number of protests, or there would be no protests at all. And if they're not as proactive, they're still engaging with the community before the announcement of a deal and encouraging the community groups to maybe participate in the comment periods for the proposed acquisition, in an effort to kind of expedite regulatory approval and the merger application process generally, and just contribute to the overall like Community Reinvestment Act commitment to the community.
And to give an idea of sort of the consequences of having a protest and having to deal with it, whether it's through a hearing or taking the time to negotiate, reactively to protest, we're seeing, probably a processing time of 3 times the processing time for an application that is being protested versus one that's not being protested and typically can be approved under delegated authority. So obviously the advantages and the incentives to try to avoid one of these protests is pretty significant. And so I think, bottom line, to the extent that you can, negotiate, quote, negotiate with these community groups in advance of a deal, as opposed to potentially being held hostage, has some significant advantages. So just moving on, 2022 obviously was not the greatest year for bank M&A, both from a deal volume as well as from a deal value perspective. And from the beginnings, we have the advantage of seeing, as Nathan noted, the early part, a month and 3 weeks into February, and it looks like, at least so far, that deal volume is even worse than it was. It ended in 2022, and certainly looking like we're not seeing. Not only are we not seeing large bank M&A, but we're almost not seeing mid-sized bank M&A. Most of the deals seem to be exceptionally small from the environment. And so Nathan, what's the thinking, in terms of the continuation of the factors you noted further, what's affecting, bank M&A, this year, and what's your thoughts in terms of going forward and the continued effect that's going to have on deals, the remainder of this year and perhaps even longer?
Yeah, it's so you're right. I mean, as we talked about the last January and February, very slow. February might be even slower than January for deal activity. I think buyers are going to remain cautious, but I think buyers that view M&A as a line of business, not just a entity that does one deal, but someone who does a deal every year or two. I think those discussions continue, where buyers that want to talk to sellers, discussions that take time for a deal to come together. And if the buyer's currency strengthens, stock prices improve, that buyer has more pricing power, and maybe you see some more activity as the result of that. But I think it's going to remain. Some of the issues we talked about are going to remain for overhangs in 2023. The interest rate issue, and the loan marks, I don't see that getting better in the near term. But again, you can a buyer can structure around that. What we may have is another overhang is just being some bid ask spread between what sellers' expectations are and what buyers can structure and pay. But the need for M&A activity hasn't gone away. So some of the normalized deal activity may be pushed into 2024. Maybe we see some pick up later in the year. But again, the factors that drive M&A are long term.
So are you seeing, Nathan, more of an obstacle from the selling side or more of an obstacle, from the buying side in terms of where things are? Is the interest remaining strong from potential sellers and buyers can't really wrap their arms around, the current environment, or the other way around?
I mean, I think it's a little bit of both, but I'd say the buyer landscape, if I took a look at a buyer landscape today versus a year ago, there are arguably fewer buyers given the stock prices have come down. And because of that, right, sellers then say, well, I'd rather, maybe sit on the sidelines a little longer until the buyer landscape improves. But I think it's the buyers first, but it causes the sellers to also back off a little bit.
And as a buyer of banks, Laura, generally, how is the current environment sort of affected your thinking and your strategy? How do you view sort of the effect of the overhang of interest rates and the potential marks to targets, securities portfolios, and how that could result in dilution and so forth, and goodwill, and then the looming effect of potential credit marks going forward? How does that affect your strategy?
Yeah, I think I agree with Nathan that people are still willing to talk about deals. The smaller institutions are feeling pressure on their net interest margins and other small bank factors that have been challenges: the regulatory environment, the technology, compliance costs money, and succession. So those are still out there, and people are willing to talk. I think that we're expecting that towards the end of the year, there might be, if the stock prices at least don't stay depressed, I think that there could be some deals done later. That's how we're looking at it. We're still talking to people and keeping those doors open. And you can structure, as Nathan pointed out, you can structure a deal around some of those credit marks and the AOCI even. With the interest rates either settling at least by the end of the year, or maybe Fed is going to stop increasing rates, there's a little bit of the angst over the AOCI may start to diminish too. So if going forward, we see 2023, towards the end of 2023, perhaps a better environment for deals.
Have you looked and sort of thought that, to the extent there was a target that you really liked, but if it had at least exposure from an interest rate mark perspective, has that concerned you generally with respect to trying to structure a deal that has the proper amount of goodwill earned back that's acceptable to the street? Has that been a constraint in terms of you looking at transactions currently that sort of needs to be worked through in the current market?
Sure. I think that the way that we look at it, we've always been pretty disciplined and trying to dig down and model what we think that is realistic. And if it just doesn't work, maybe the timing isn't right or something. But I also think that it can be polished, the price, the stock prices, I mean, there's a lot of factors that are variable in that, but right now it does make it a very challenging environment to make the numbers work. I think towards the end of the year, we're looking at maybe some better, more stable environment for deals.
Nathan, if you had to sort of generalize, what type of multiples and what type of earn back for tangible book value dilution would be acceptable for a public acquirer these days? Is it less than what historically has been acceptable? As you sort of mentioned, some of the core reactions that some deals got in 2022 that might have put a chilling effect, particularly on larger bank M&A during the year?
Yeah, that's a good question, Jeff, and it's a tough one to really have an exact answer on, because each deal can be different and different rationale for a deal, whether strategic or more financial, and so forth. But in terms of tangible book dilution, I think that's been a key focus for investors, really not wanting to see deals that are too dilutive to tangible book value. Certainly getting above, kind of a 4 or 5% range of dilution of book value may draw some more attention. And the earn back is a metric that some folks are very focused on, right or wrong. And the tangible book dilution earn back periods, when you get above 3 years, again, starts to draw some attention. And certainly when you get above 4 or 5 years, that's where we've seen some of the more negative reactions from the street. But buyers, are gonna also benefit from the EPS accretion, right? And so getting, there's some adjustments that need to be done in this environment, because of some of the interest rate challenges we talked about. Accretable yield is causing higher rates of EPS accretion as that the loan mark comes back into earnings. But so a model needs to evaluate all of these things and make sure that the return, ultimately the return on the investment, pencils out. But I view it as PE ratios and price to book ratios are important in terms of figuring out what the currency as a buyer, what can work, and making sure it's structured properly.
Thanks. Amelia, there's been some, particularly over the last few weeks, talk amongst or from the regulators and people commenting on the regulators, and been some little bit of distinction between some of the Fed governors in terms of bank regulation, M&A regulation in particular. Maybe you could just speak briefly in terms of what we're seeing and the effect it may have going forward on the regulatory environment affecting bank M&A this year and in the future.
Yeah, so I think there's a broad consensus among all of the regulators that the way that these bank mergers are being assessed currently needs to be updated. But the question that they're all kind of struggling with is how best to update these merger guidelines. As we've talked about, they are currently enhancing their scrutiny and review of applications while they're trying to figure out the best way to change this process going forward. Obviously, the slowdown in bank M&A generally, as we've discussed, has been really related to other things as well as recessionary fears and lower stock value. But ultimately, the discussion about changing these merger guidelines is focused on competition and competitive factors. The OCC hosted a bank M&A symposium earlier this month, where they kind of discussed how specifically the competitive analysis used for bank mergers is antiquated and outdated, and focuses, on geography of the bank and bank deposits. But these have kind of become less relevant because banks are not just operating with deposits, and the increase in technology and digital innovation has kind of increased the competition among non-banks. So it's not just banks competing for bank M&A, and there are non-banks involved as well today. So I really just think that it will take some time to implement any updated merger guidelines and agree on what those will look like. But I think we're getting a feel that they are going to be increasingly focused on competition, financial stability, convenience and needs, and evaluating bank mergers, which are all things that are currently considered. But I think the processes to consider these are going to be significantly changed, and we're going to continue to see higher scrutiny and higher review and more questions on these particular topics.
I think the hope is that as we see, maybe questionable mergers, and be subject to more scrutiny, that, good mergers, beneficial mergers, which there are, which I think most of the deals being announced, consolidation in the banking industry has been historic and has happened, as Nathan noted, at a pretty hefty pace generally. And I think the hope is that, what's going on now doesn't put a chilling effect on good deals going forward. And so let's just hope that that's the case. And really, speaking of just M&A, one of the things, I attended an M&A conference, earlier, beginning of the month, end of last month, and one of the sort of themes that we were hearing is that even though bank M&A remains pretty muted, as you noted, Nathan, the reasons for bank M&A, and Laura noted as well, remain real strong. And maybe, Nathan, if you could sort of talk about the factors that still advocate and are driving and incentivizing both buyers and sellers to look at and engage in discussions with their counterparties on bank M&A might be helpful.
Sure. I mean, Laura touched on really, the key points that are I'd call long-term drivers to M&A in the banking industry. It's succession planning is a key issue. As CEOs retire and having the right person to fill that role. Does a board move forward with a new CEO or find a partner? Financially, the issues weighing on those decisions are just operating performance. Maybe the returns, profitability, and so forth have not been high enough to justify remaining independent. And a board decides that it's more compelling to take to do a deal and either take cash or another currency, but receive a premium. So I'd say those are a couple. The regulatory environment, there are certainly challenges with that as you're a smaller bank. And the technology today is a must-have. It's not an option. And implementing technology to remain competitive is just, again, more and more challenging with a smaller size. On the buy side, Jeff, it's banks that want to continue to grow, want to create more efficiencies of scale, and can do so through M&A quicker and sometimes more effectively, or to supplement organic growth. And so we've seen plenty and created, meaningful shareholder.
You've had done real well continuing organic growth, but we've seen a number of the banks that we come in contact with across the country are being challenged from an organic growth perspective in this environment. They're either fearful of the potential turn in the credit quality, and so are cutting back some of their commercial C&I and commercial real estate lending. That doesn't seem to at least affect the numbers that I'm seeing from you. But how have you looked at from a client perspective, sort of viewing hopefully a turn in terms of the economic and interest rate environment, at least sometime, hopefully sooner rather than later this year, and how that weighs in and affects your M&A strategy going forward?
Sure. Well, I mean, the one of the biggest things right now for us is the bank stock prices being depressed. So our currency isn't as valuable as it was even the first part of last year. So that's a big factor. And the other factors are, for us anyway, are the market that we're going into. There are some markets that are attractive for us. We were able to, through acquisition, diversify our loan portfolio, and that was one of our goals. So we would look at things like that. Of course, the marks, the credit marks and the yield mark on the credit portfolio has been probably more dramatically impacted than the actual credit quality mark, at least in our recent acquisition. So we're looking at all of those factors. They all apply, but I think that it can be structured if there is a deal that is beneficial for both the buyer and the seller. There are still deals that can be done. It's just a matter of factoring those into the structure of the deal.
How about, one of the things that hasn't been really a relevant concern in the banking industry, at least in my opinion, for a number of years, and certainly, we're sort of exiting one of the most liquid periods of time in the banking industry, where I think there was so much liquidity put into the system based on the accommodative Fed policies, and we're really for the first time seeing the effects, and in some cases dramatic effects, on liquidity hitting banks. And liquidity has not been an issue for banks in quite some time. This is for really Nathan and/or Laura. What do you see in terms of liquidity, potential liquidity concerns, particularly from sellers, as we're seeing a lot of deposits migrate out of the systems, looking for higher yielding alternatives, many banks having to rely on wholesale funding. How do you guys see that affecting bank M&A in at least the near term?
Well, I mean, for sellers, Jeff, I mean, that issue is one of the I'd say key challenge, just key issues going on in the industry right now. For sellers, it's for some that have strong core deposit bases, they're more attractive in this environment, right? Having core deposits for the first time in a long while means something, and there's more value for a core deposit franchise. And that's a reason for some buyers to look at a target is that's much more relevant than it was a year ago. Rates were low. It's also on the converse though that some banks that don't have as strong of core deposits are seeing pricing pressure where funding costs are coming up. They may have a higher loan to deposit ratio, so they have to continue to chase deposits. And that that poses its own challenges for both. It's maybe a less attractive target, and buyers are not going to be assigning the same sort of a premium for a balance sheet that may be under pressure.
I totally agree. Core deposits, we have always looked for core deposits, not necessarily the the CD specials and that sort of thing, but, or the CD only type of customers or public deposits. But right now, we're looking at all of those deposits, and particularly core deposits, I think are very valuable right now. So would be extremely beneficial.
So, before I just open up the panel to potential questions, I guess I would just, go back, and I think I can sort of sense what everybody's outlook is for bank M&A generally, but what you're thinking in terms of, let's say, sometime, sooner rather than later, at least the Fed, stops raising rates, if not, reverses course, and we're looking at maybe a quote softer landing as opposed to a hard landing. What you're thinking in terms of bank M&A, even though you sort of gave a little bit of a preview in your some of your comments.
I mean, Jeff, from my perspective, I think it's, we may see some rebound in some activity late in the year. But I don't have high hopes for Q2 to see, a resurgence. But to your point, as with a more accommodative Fed and maybe some more clarity on the economic picture, I do think that will, increase confidence among both buyers and sellers that, there's a window of, a window is opened for deal activity to resume.
Yeah, the way we're looking at it is we're getting prepared. And I think that towards the end of the year, the uncertainty might at least be stable. And we may know a little bit more from the regulatory merger policies if they're changing, what Amelia was talking about. And I had a friend tell me that it seems like the regulators might be a solution looking for a problem. So those kind of things getting defined for us, I think would help, whatever it is. I mean, just so it's defined. And I think people would settle into whatever those new rules might be. But we're not changing our strategy on M&A. We've always, for a long while, had a two-prong approach to our growth, and one is through organic growth, which we have a lot of capacity in our markets, and one is through acquisition. So we're aware of some of the challenges right now, but we're still willing and able to talk about deals.
Yeah, I pretty much agree with both Laura and Nathan. I do think that perhaps we'll still continue to see some small bank M&A throughout the year, but I don't think that we're going to see a significant change until probably early 2024.
Probably the first year that I didn't start the year with, both lawyers and investment bankers expecting, the dam to break on bank M&A. And so I agree. I think, there's hoping that maybe later in the year, we'll see a little, more certainty and less uncertainty. It could cause bank M&A to rebound in a more measured pace. But I think certainly until then, and perhaps more likely into 2024, I think we're looking at a continuation of what we've experienced in 2022 and the beginning of 2023. I want to thank everybody and just open it up. Sarah, if you want to open up to if anybody has any questions for any of our panelists. Looks like everybody answered all the questions, so it looks like nobody has any follow-up. I want to thank everyone. I want to say that I learned a lot. today. Hopefully, people participating did as well. And, great panel. And I hope, if there's any follow-up or anybody's looking for some information, please reach out and put you in contact with folks. But appreciate everybody participating, and hopefully 2023 will pick up sooner rather than later.